Hey everyone, welcome to the 10-Minute University. Let's talk about something super important, especially for you Gen Zers and millennials out there. Credit scores. Yeah, I know, it might sound kind of boring, but trust me, this stuff is crucial. Think of your credit score as your financial GPA, the higher the better. A good credit score can unlock some awesome opportunities, like getting that dream apartment or snagging a sweet interest rate on a loan. So, whether you're just starting out or looking to boost your score, stick around and let's decode this whole credit score thing together. We're going to break it all down from what a credit score even is to how it's calculated. Plus, I'm going to share some killer tips that you can actually use to improve your score. And don't worry, I'm keeping it real and relatable, just like hanging out and chatting about money stuff. By the end of this, you'll be well on your way to becoming a credit score master. Now let's dive in. Okay, so what exactly is a credit score anyway? You might have heard about it in passing, maybe from a friend or a financial advisor, but what does it really mean? In a nutshell, it's a 3-digit number that represents your creditworthiness. This number basically tells lenders how risky it is to lend you money. It's like a quick snapshot of your financial behavior. Think of it like a financial report card that sums up your creditworthiness. Just like in school, where your grades reflect your academic performance, your credit score reflects your financial performance. This score is crucial because it influences many aspects of your financial life. This magic number typically falls somewhere between 300 and 850. The higher your score, the better your financial standing in the eyes of lenders. A higher score means you're considered more trustworthy and responsible with money. It shows that you have a history of managing your debts well. Now, why should you even care about this mysterious number? Well, it plays a huge role in your financial life. It can affect everything from your ability to rent an apartment to the interest rates you get on loans. Landlords might check it before handing over the keys to your awesome new apartment. They want to make sure you're reliable and will pay your rent on time. Trying to finance a car? Your credit score will be a major factor in what kind of interest rate you get. A higher score can mean lower interest rates, which can save you a lot of money over the life of the loan. Even insurance companies peek at it to determine your premiums. A good score can mean lower insurance costs. Basically, a good credit score can save you a ton of money in the long run. And who doesn't love saving money, right? It's like getting a discount on almost everything you finance. So, how do we figure out this magical number? What goes into calculating it? Let's break it down in the next section. Stay tuned to learn more about the factors that influence your credit score and how you can improve it. Alright, let's demystify this whole credit score calculation thing. It's not as complicated as it might seem at first glance. The most common model used is the FICO score, and it's based on 5 key factors. These factors are like the building blocks of your financial reputation. Think of these factors as the classes on your financial report card. Each one contributes a different weight to your overall grade. First up, we've got payment history, the heavyweight champ, accounting for a whopping 35% of your score. This is the most significant factor. This one's all about whether you pay your bills on time. Consistently paying your bills on time shows lenders that you're reliable and responsible. Late payments? Missed payments? Yeah, those are going to hurt your score like a bad case of procrastination. Even one late payment can have a significant impact. Next, we've got amounts owed, making up 30% of your score. This factor is all about your debt levels. This factor looks at how much of your available credit you're actually using, also known as credit utilization. It's a measure of your debt-to-credit ratio. The lower your credit utilization, the better. Ideally, you want to keep it below 30%. Think of it like this. You've got a credit card with a $10,000 limit, but you only use $3,000 of it. That's a 30% utilization rate. That's a healthy credit utilization ratio, showing lenders you're not maxing out your cards every month. It indicates that you manage your credit well. Now, let's move on to the remaining factors, which play a smaller but still significant role in your overall score. These include length of credit history, new credit, and credit mix. Length of credit history makes up 15% of your score. It looks at how long your credit accounts have been open. The longer, the better. New credit accounts for 10%. This factor considers how many new accounts you've opened recently. Opening too many new accounts in a short period can be a red flag. Finally, credit mix makes up the last 10%. This looks at the variety of credit accounts you have, such as credit cards, mortgages, and auto loans. A diverse mix can be beneficial. So, there you have it. Understanding these factors can help you take control of your credit score and improve it over time. Remember, good credit opens doors to better financial opportunities. Remember how we talked about payment history being the big kahuna of your credit score? It's the most significant factor, making up about 35% of your score. This means that your ability to pay your bills on time is crucial. Well, here's your first golden rule. Pay your bills on time. This might sound simple, but it's incredibly important. Late payments can stay on your credit report for up to 7 years, affecting your ability to get loans, credit cards, and even housing. Seriously, this is non-negotiable. Set up autopay, reminders on your phone, whatever it takes to avoid those dreaded late fees and credit score hits. Autopay ensures that you never miss a payment, and reminders can help you stay organized and on top of your finances. Even one late payment can ding your score, so be proactive and stay on top of those due dates. Consider setting up multiple reminders, like a week before and a day before the due date, to give yourself plenty of time to make the payment. Now let's talk about amounts owed or credit utilization. This is the second most important factor, making up about 30% of your credit score. It refers to the amount of credit you're using compared to your total credit limit. A good rule of thumb is to keep your credit utilization below 30%. This means that if you have a total credit limit of $10,000, you should try to keep your balance below $3,000. That means if you've got a $10,000 credit limit, try not to have a balance higher than $3,000. High credit utilization can signal to lenders that you're over-reliant on credit, which can negatively impact your score. Think of it like a delicious pizza. You don't want to eat the whole thing in one sitting, right? Similarly, you don't want to max out your credit cards. Spread out your spending and keep your balances low. The same goes for your credit limit. Use it responsibly, and your credit score will thank you. Regularly check your credit card statements and make sure you're not overspending. By mastering these two factors alone, you'll be well on your way to building a solid credit history. Remember, good credit opens doors to better interest rates, loan approvals, and even job opportunities. But wait, there's more. Let's move on to the next set of tips. Stay tuned to learn about other crucial factors that can help you maintain and improve your credit score. Section 5, Tip 3 and 4, Credit History Length and New Credit. The third factor in our credit score breakdown is length of credit history, accounting for 15% of your score. Basically, the longer you've been responsibly managing credit, the better. Lenders like to see a track record of responsible borrowing and repayment. Now, I know some of you might be thinking, but Graham, I'm just starting out. How am I supposed to have a long credit history? Don't worry, we'll get to that. Next up, we've got new credit, making up 10% of your score. Opening a bunch of new credit accounts in a short period can actually hurt your score. Why? Well, it can be a red flag to lenders, making it seem like you're desperate for credit. So, my advice? Only apply for new credit when you truly need it, and space out those applications. Now that we've covered those factors, let's move on to the final 2 tips. Section 6, Tip 5 and 6, Credit Mix and Old Accounts. The fifth factor influencing your credit score is credit mix, which makes up the final 10%. Having a diverse mix of credit, like credit cards, installment loans, think car loans or student loans, and maybe even a mortgage down the line, can actually boost your score. It shows lenders you can handle different types of credit responsibly. Now, remember how we talked about the importance of a long credit history? Well, here's where those old accounts come in handy. Even if you don't use a particular credit card anymore, keeping it open can actually help your score. Closing old accounts can shorten your credit history, which might not look so great to lenders. We're almost at the finish line. Let's wrap up with our final 2 tips. Section 7, Tip 7 and 8, Secured Credit Cards and Reporting Rent. Alright, if you're new to the credit game or have a limited credit history, a secured credit card can be a great way to dip your toes into the credit pool. Basically, you put down a security deposit, which typically becomes your credit limit, and use the card like you would any other credit card. By using it responsibly and paying your bills on time, you can build a positive credit history. Here's another tip, especially for all you renters out there. Did you know that you can actually get credit for paying your rent on time? Yep, it's true. There are services out there that will report your rent payments to the credit bureaus, giving your score a little boost. And there you have it. Those are my top tips for mastering your credit score. But before we wrap up, let's talk specifically about you, Gen Z and Millennials. Section 8, Gen Z and Millennials, this one's for you. Now, I know you guys face some unique financial challenges. You've got student loans, you're entering a tough job market, and let's be real, avocado toast isn't going to pay for itself. But here's the good news. You've also got a powerful tool at your fingertips: technology. There are tons of awesome apps and websites out there that can help you track your spending, monitor your credit score, and even set up payment reminders. Take advantage of these tools. They can make managing your finances so much easier. Remember, building a solid credit history takes time and effort, but it's one of the best investments you can make in your financial future. So start now, stay informed, and watch your credit score soar. You got this.